And Daniel, talking about that economic reality, looking at the latest German data, the PMI manufacturing number coming in really weak with a 43 handle. Does that not, in contrast to what you were saying, does that not build a case for perhaps more stimulative action by the German government, maybe a little bit more debt, given how low bond yields are?
Well, you would say that, but there's absolutely no evidence that the German economy is spending less than what it needs, that it's investing less than what it needs, or that there is any type of government spending problem. In fact, what I think is a risk is that if Germany follows the path of France and decides to increase the imbalances via more government spending, what it would actually do is not improve the manufacturing and services side of its economy, but actually make it less dynamic. I think that the problem of the Eurozone is much more complicated than just an ECB stimulus or a government spending plan. I think it's a question of an entire economic area that has completely abandoned structural reforms, an economic area that is ignoring the challenge of demographics, and that is completely abandoned the race in technology. So productivity growth, government spending, all these things continue to be a burden on the economy.
And if governments are not doing enough then, or not doing the right things, in your view, Daniel, what about the ECB? Are you expecting any movement from the ECB either this week or next, or in September?
I think that the ECB right now is stuck between a rock and a hard place. On one side, it knows that the Eurozone problem is not a problem of liquidity or of low rates. As you know, rates are negative. Governments are financing themselves at the lowest rates ever. Even Italy, with all the challenges that it faces, is financing itself at 1.5% on the 10-year bond. And the 50-year bond that it issued received massive demand. So it's not a question of how cheaply the governments are financing themselves or how high liquidity is, because there's almost 1.8 trillion euro of excess liquidity at the ECB. But the ECB knows as well that a lot of those figures that we're talking about don't come from secondary market demand. There is actually very little signals out there that investors would be buying Eurozone bonds at these yields if the ECB was not supporting. As such, I think that it will continue to increase its stimulus. I think that we will see a rate cut, and I think that we will see also probably a QE that will involve not just bonds, but probably also equities, sort of mirroring the structure of the Japan market. Yeah.
Daniel, I have to ask, you have advised Spanish conservatives at the highest levels on finance and economics. What would you do if you were Olaf Scholz? I want to put you in the position of the German finance minister here, and you had to deal with the Deutsche Bank problem, the fragmentation here. What would you do in order to make sure that your banking industry in Germany was strong and helped with your future economy? He's in such a difficult position.
Yes, what I think that, for example, what Spain did in the crisis with the financial sector reform was a very important step, which is improve transparency and at the same time avoid the idea that merging weak banks is going to help those banks get stronger. Two weak banks don't make a stronger bank, they make a weaker bank. So I think that we've learned from the past that it's not a good idea to try to disguise the issues of one bank by putting it together with another. I think that the other element is that what Deutsche Bank is doing is actually the correct strategy. It's reducing costs, it is improving transparency, it's going to start separating part of its businesses. So the only thing that the German government needs to do is to ensure that there is enough transparency so that nobody starts believing that there is some hidden data out there that would show that the banks are in a worse situation than what they are. And I think that transparency here is what is going to help those banks improve. And obviously increase rates, support an increasing rates.
Daniel. Yeah, thank you. Very good place to lead the conversation. Thanks very much, Daniel Lacalle, Chief Economist at Tressis.